Hi, this is Dan Collins, trading editor for MoneyShow.com, coming to you live from Traders Expo, New York. Joining me is Toni Hansen from ToniHansen.com.
Right.
I say it twice. It is just ToniHansen.com. We're going to talk about momentum, and Toni has kind of a unique take on momentum because you don't actually use momentum indicators, do you?
No, I don't.
Well, how do you measure momentum?
Okay. Well, I rely upon doing a lot of trading with actually just looking at pure price action, not using a lot of indicators. But when I'm looking at momentum, I'm basically looking at the rate of change of price action in the market. So for example, if you want to compare current momentum on whatever price is happening right now, I look back in a security and I look for those periods where you've got the V's and the inverse V's, those trading ranges. And within one side of it, if there's a good deal of overlap on the upside, that's usually a pretty average momentum move, or you'll get like a strong sharp move up, a little bit of a correction, and then another sharp move up. And if you transect that, that's also telling you that that's about average to slightly above average momentum. And so then what I do with that is that when I'm looking at how the current move is playing out in the market, I'm comparing it to what is average. Is this move stronger than average, or is it slower than average? If it's stronger than average, I know that my odds of a correction are more likely to be a lot choppier. So when I get like measured move levels hitting, or like major levels like Fibonacci support or resistance, or previous highs or previous lows, if it's much stronger than average going into that, I know that it can shift at that point. And even if it reacts really sharply, there's a good chance it's going to try to go back and retest those highs. So if something rounds off at highs and you get more of a rounded high, you'll see this with like inverse cup with handles or head and shoulders. Those are all patterns where the momentum's actually rounding off and shifting, and you can get a much stronger reversal, like a much more solid reversal when that happens.
Okay, how are you measuring average when you talk about average?
Right, so that's that zone where you're in the trading range and you're looking for that back and forth action. And so that gives me a standpoint of where I can say, hey, this is average. So current action right now, how does that compare to each side of those typical V's? You can't say like a 45-degree angle or something like that, because if you change your scaling, you're going to change the angle. Or if you change your time frame, something might look gradual on one time frame, you go up to a larger time frame and it's just a steep drop. So you have to look at the bigger picture, not just the smaller current action, but how does it compare to the typical action in the past before that.
Okay. Now, do you use volume in that?
You're like, what do you use for indicators? Actually, you know,
well, that's not an indicator per se.
Well, it is, because people are using it to judge what's happening with price action. You know, how much interest is there in a security? And I used volume religiously for like the first 15 years I traded. And I don't know what it was, but at some point I removed volume from my charts, and I just never added it back. And so I'll use it for teaching like certain strategies, because like if you're in like a trading range and you're looking for a nice continuation breakout, ideally you want volume to be dropping during it. But I think it's just because I have so much experience with how volume typically happens, I don't really need it on my chart anymore.
Did it get in the way? I mean, some indicators can get in the way because volume, I think most people use volume. There just has to be enough volume, because if there's absolutely no volume, then there's no legitimacy to the move. And with more trading liquidity, with higher volume, most moves are legitimate.
But that's relative, because a lot of the best setups happen right when volume gets to be like the lightest it's been the entire day. So if you're looking at like a trading range and you're seeing volume drop off, everybody's like, oh, this is so boring, I'm gonna go grab some coffee, make some lunch, and they come back and they completely miss the move, because it takes off from that point of where there's no volume. Or they wait for a trading range to actually fully break and for volume to confirm before they take a position. Well, then you're at a point where it's most likely that it could even pull back and retest the range, and people will get taken out because they'll move, like they'll have break-even stops or things like that.
That's a great point that you just bring up, because a lot of people bollocks themselves up by looking at too many indicators, and then they're caught not doing anything.
Right. But I like to get in before the breakout, and that volume drop tells me that it's getting ready to break out. So if I see a nice trading range, and then I've got a smaller range at the top part of that, where momentum is even more gradual, and volume's just the lightest it's been the entire session, that tells me I'm getting to be at a do or die point, that I need to be here paying attention to this, because it's getting ready to go.
All right, Toni, great to have you with us.
Thank you.
This has been Dan Collins with Toni Hansen, live from Traders Expo, New York.